Accounting entries of advance income tax, TDS receivable, self-assessment tax, and tax payable or refund receivable from income tax. I am Sabu Joseph. Welcome to SVJ Academy. Hundreds of practical and useful videos relating to income tax, TDS, EPF, ESI, Microsoft Excel, and other accounting classes are available in my channel. Kindly watch it and drop your comments. Channel will be very much useful for the commerce students as well as the accountants, especially new accountants and accounting job seekers. Please subscribe my channel if not subscribed yet, and please enable the bell icon to get real-time notifications. And if the videos are really useful, please share the channel to your friends and colleagues. For the better understanding about the accounting concepts, practices and discussion, a Facebook group is also available. Kindly join the group. You can share your doubts, ideas and requirements on the group. More than 3,000 members are already joined the group. They are sharing their ideas and doubts on the group. So please join the group. In this video, I will show you how to pass journal entries in our accounting software relating to payment of advance income tax, TDS receivable, payment of self-assessment tax, and the income tax payable to the income tax department as per the assessment order, or the income tax refund receivable from the income tax department. Before going to this session, we have to understand some topic. The new accountants or job seekers may not be well aware of these terms. So kindly go through this topic. The first one is, what is advance income tax? Advance income tax means income tax should be paid in advance instead of lump sum payments at the year end. These payments have to be made in installments as per due dates provided by the income tax department. Who is liable to pay advance income tax? We can categorize the advance payment of income tax into three: salaried employees, professionals and businessmen. If the total tax liability is rupees 10,000 or more in a financial year, you have to pay advance tax. Senior citizens 60 years or older and do not run a business are exempt from paying advance tax. So the salaried employees, professionals and businessmen whose tax liability, when we assess the tax liability, if it is rupees 10,000 or more, then they have to make advance income tax payments as per the due dates fixed by the income tax department. The second category is presumptive income from business. Suppose some businessmen may select the presumptive basis of income tax. So the taxpayers who have opted for presumptive taxation scheme under section 44 AD have to pay the whole amount of their advance tax in one installment on or before 15th March of every year. They also have an option to pay all their tax dues by 31st March of that year. This is for the business people who opted for the presumptive taxation. If a professional opted for the presumptive taxation, they have to pay the whole of their advance tax liability in one installment on or before 15th March of that year. They can also pay the entire amount by 31st March of that year also. What are the due dates and amount of advance tax? We can make the advance tax payments by 4 installments in a year. So what are the due dates? The first advance tax payment we have to make on or before 15th June of that year. Then how much is payable? See the table. On or before 15th June, we have to pay 15% of advance tax. On what? First of all, we have to simply assess the tax liability of that financial year. If it is 21-22 financial year, now we have completed around 2 months. We have to assess how much will be our total revenue or income or sales for this current year, and how much will be our expenses, and what will be the tax liability. It's an estimate only. Based on that estimate, we can calculate the income tax. That income tax we should pay in installments paid on or before 15th of June. The amount will be 15% of that calculated tax liability. The second installment we have to pay on or before 15th of September. That should be 45% of advance tax less the advance tax we already paid. The third installment will be on or before 15th of December. The amount will be 75% of advance tax less the advance tax we already paid. On the fourth installment, this is the last one, we have to make the payments on or before 15th of March. How much will be the amount? 100% of advance tax less advance tax already paid. So you may be confused with the percentage of tax. That we can clear. See the example of advance tax amount. The due date is shown here and the advance tax payable percentage is shown here. We calculated our tax liability and the liability comes to 1 lakh. How can we pay this 1 lakh under these installments? So on or before 15th June, we have to make payment of 15% of the assessed tax. So the 15% of 1 lakh will be 15,000. This is the first installment we have to make on or before 15th June. The second installment will be on or before 15th of September. That will be 45% of advance tax less advance tax already paid. So in this case, 45% of 1 lakh, it will be 45,000. Out of that 45,000, we have to less the tax we already paid. So 45,000 minus 15,000. The rest of the amount will be 30,000. This 30,000 we have to make the payments on or before 15th of September. The third installment will be on or before 15th of December. 75% of advance tax less advance tax already paid. That means 75% of 1 lakh, it would be 75,000. 75,000 minus the tax we already paid. In this case, 75,000 minus 15,000 minus 30,000. The rest of the amount will be 30,000. So this 30,000 we have to make the payments on or before 15th December. This is the third installment. The fourth installment will be paid on or before 15th of March. 100% of advance tax less advance tax already paid. So here the 100% of advance tax will be 1 lakh. So the 1 lakh minus the tax we already paid. 1 lakh minus 15,000 minus 30,000 minus 30,000. So the 1 lakh minus 75,000. The rest of the amount would be 25,000. This 25,000 we have to make the payment on or before 15th of March of that financial year. This is the method of calculation of advance tax. So this will be for the salaried employees, businessmen and professional. Suppose if the businessman opted for the presumptive taxation, then they have to make only one installment on or before 15th of March. So in this case, they have to make a lump sum amount of 1 lakh on or before 15th of March, or they can make the payments as on 31st of March. Then they have to pay 1 lakh. In the case of professional who opted for the presumptive taxation, they also have to make a single payment on or before 15th of the March. It will be 100%. So in this case, the professional also make a payment of 1 lakh on or before 15th of March, or they can make the payment on or on 31st of March. So this is the example of calculating the advance tax and its due date. Suppose we are failed to make the payment of advance tax, then what will happen? If we fail to make the advance tax or the paid amount has been less than the amount as per the calculation, then we have to pay interest. That interest is calculated as per the two sections, as per section 234B and as per section 234C. The 234B means if the advance tax paid by the taxpayer is less than 90% of the assessed tax, interest is calculated at the rate of 1% on assessed tax less advance tax paid. So in this case, we have paid the 100% of advance tax on or before 15th of March. Suppose if we fail to remit the fourth installment of 75,000. Now how much we paid? 75,000 we already paid. So as per 234C, we have to make not less than 90% of the amount. So the 90% of 1 lakh comes to 90,000, but we have paid only 75,000. So we have to pay interest under section 234B for the rest of the amount of 15,000. This is the calculation of 234B. And the 234C means short payment or non-payment of individual installments of advance tax. Then we have to pay interest at the rate of 1% per month to the government. So in this case, we are not making the advance tax payment, or the advance tax amount we already paid would be very short. This is the interest payable to the government for the non-payment or short payments or deferment of advance tax. Now we have seen what is advance tax and what are its applicability. Now we can go to our session. In a financial year, we may have several ways of income tax payment. So the first one is how to record advance income tax payment. Suppose we have to pay 50,000 as advance tax. What will be the payment entry? The debit will be advance income tax 50,000. The credit will be to your bank name. This advance income tax will be under current assets, loans and advances. So this is the entry for recording the advance income tax payment. The second will be tax deducted at source. When we receiving payment from our debtors or from somebody, they may deduct TDS. That TDS is an asset because they are remitting the income tax to the government for and on behalf of us. So that TDS we have to claim from the government. So the second will be to record the tax deducted by others. Suppose rupees 10,000, where we will debit. The debit will be TDS receivable and the credit will be the concerned debtor name or the party name. So TDS receivable will be debited and the concerned debtor or given party will be credited. This TDS receivable will be considered an asset and will be under current assets, loans and advances. The third case may be we may create a provision for the income tax. After finalizing the financial statements and computing the tax liability, we have to remit the self-assessment tax. So the third will be to create the income tax provision. Suppose it is 65,000. We have to make an income tax provision of 65,000 where we will debit. So we have to create a new account, income tax. So we have to debit to income tax and the credit will be to provision for income tax 65,000. This income tax will be an indirect expenses under P&L account and the provision for income tax will be under current liabilities because we are creating a provision for making the payment. It is not paid. So to create an income tax provision, the debit will be income tax and the credit will be provision for income tax. On the fourth case, sometimes we have to set off or transfer the advance income tax amount to the provision because in this case we created a provision of rupees 65,000. That is as per the financial statement. We already remitted an advance tax of rupees 50,000 and TDS of 10,000 which is deducted by one of our debtor. This advance tax and TDS receivable we can adjust with the provision for income tax. The rest of the amount only we have to make payment. So on the next case, we can set off or transfer the advance income tax with the income tax provision. We have to debit to provision for income tax rupees 50,000 and credit given to advance income tax which we already paid to the government. Now our advance income tax account closed. The provision for income tax reduced by 50,000, now showing 15,000 as the credit balance in provision for income tax. Again, we have a TDS receivable that also we have to set off with the provision for income tax. So on fifth stage, set off or transfer TDS receivable with the income tax provision. Here also we have to debit provision for income tax 10,000 to TDS receivable 10,000. This is the amount available under TDS receivable account. Now the TDS receivable account is closed. Now what will be the rest of the amount in provision for income tax? Already we created a provision of 65,000 which is on the credit side of the provision account. Now we have passed two debits 50,000 and 10,000. The balance credit will be 5,000 only. This 5,000 we have to make the payment to the government. So on the next stage we have to make the payment of balance amount payable to the government. That means if the provision account is showing a credit balance, that means balance tax payable. Debit to provision for income tax, in this case 5,000. Credit to your concerned bank name 5,000. Now our three accounts are closed. Advance income tax closed, TDS receivable account closed, provision for income tax is also closed. Suppose if the provision account is showing debit balance, that means the advance tax and TDS amount is greater than the income tax provision. What we will do in such case? If the provision is less than the advance income tax and TDS receivable, the balance amount we have to claim from the government as refund. So in that case, if provision for income tax shows a debit burden, that means excess amount paid to the government as advance tax and TDS. So we have to claim that amount from the government. The debit will be income tax refund receivable and the credit will be given to provision for income tax. This income tax refund receivable will be under current assets under loans and advances. Now the provision for income tax account is closed and the excess amount transferred to income tax refund receivable, it will come under the asset side of the balance sheets under current assets, loans and liabilities. Suppose we may get an assessment order for making the additional income tax amount with or without interest after 6 months or 1 year or 2 years. So already we created everything and the income tax provision, everything is we closed, filed the income tax return. After assessment by the income tax department, they disallowed some expenses. Then they are claiming an additional tax liability with interest or without interest. So the next case will be assessment order for making additional income tax with interest or without interest. Suppose if we are paying that one, that will be the entry. We have to debit to income tax and the credit will be given to the concerned bank name. The income tax will be under indirect expenses. Now in this case we got the assessment order from the income tax department and we remitted the amount to the government. Suppose we got the assessment order and we are not making the payment now, then what will happen? So the next case will be assessment order for making additional payment of income tax with interest or without interest. We are not making the payment. In such cases, we have to record the liability. Now it is not paid, but we have to record the liability. So debit to the income tax and credit to income tax payable. This income tax payable will be under current liabilities. So don't confuse with the cases. We are analyzing the cases and its situations one by one. We have to pass entries depending on the situations. Now we got the order and we are not remitting the amount now. We are filing our appeal and waiting for the final decision. Now we seen the two assessment order with or without interest, and in first case we made the payment and the second case we postponed the payment. Suppose some business entity may have some litigation as stated now. In the previous financial years, the income tax department may issue the assessment order and they demanded the additional tax liability and the businessman filed the appeal. Now it is still payable to the government. So on the next financial year, suppose we made excess payment to the government, or in the assessment order, the income tax department has to refund some amount to the company. In this case, income tax department assessed the tax liability. The assessed tax liability is more than our taxable liability. So we have to make the additional amount to the government. In this case, the assessment order for making additional income tax with interest or without interest, but it is adjusted with the earlier refund receivable. Suppose we have to get a refund from the income tax department in any of the previous years. That refund receivable will be adjusted with the current demand. So in such cases, what we will do? So in such cases, we have to debit to the income tax payable, which is already we recorded, and a credit will be given to the income tax refund receivable, because the income tax refund receivable account is already showing a debit balance and it is also shown on the asset side of the balance sheet under current assets. Now we have to set off that income tax refund receivable against the income tax payable to the government. So if the income tax refund receivable is not sufficient to pay off the demands, the balance amount we have to make the payment. Now the income tax refund receivable account is closed. And suppose if the income tax refund receivable amount is greater than the income tax payable or income tax demand, after transferring the amount, again the income tax refund receivable account will show a balance. On the other side, it will be there. So these are the some situations of assessment orders for making the additional payment. So on the next case, we are receiving an assessment order showing the refund of income tax without interest. That means the income tax authority completed the assessment, and on the assessment, the income tax paid by us found in excess of the tax assessed by the income tax authority. That means the excess amount we remitted to the government as advance tax, TDS or self-assessment tax. As per our calculation, it will be correct. But the income tax department assessed the tax and they found the tax paid by us more than the assessable tax. So that much amount we have to get it back from the income tax department. So we have to debit it to concerned bank account, we receiving the payment, and the credit will be given to income tax refund. In this case, we are not receiving the interest for the refund. In normal cases, we will receive interest for the refunded amount because that much amount we already paid with the government. So the government has to give an interest. So on the next case, we got an assessment order showing the refund of income tax with the interest. Then what we will do? So we have to debit it to our concerned bank account. We are receiving the payments. Credit will be given to income tax refund, and one more credit we should pass towards the interest received. So the next credit will be interest on income tax refund. This interest on income tax refund will be under indirect income and comes to the credit side of P&L account. So these are the practical cases that may come across in a financial year relating to the income tax. Now we can see how we are recording these transactions in Tally. Let's go to the first one. Advance income tax account debtor 50,000 to bank rupees 50,000. So go to, already I created the ledgers for the same. So I am passing the entries. Advance income tax account debtor 50,000. The credit will be given to the bank. Here I am giving the bank name State Bank of India 50,000. Narration being advance tax, whatever the installment, whether it is first installment, second installment or third installment, mention that one, or being the advance tax paid for the financial year so and so. Save it. Now we recorded the advance tax. The next case is TDS deducted by our debtor. The entry will be TDS receivable account debtor 10,000 to the debtor. So this is a journal entry. Go to journal. The debit will be TDS receivable 10,000 to give credit to the concerned party. Here I am using the common name debtor 10,000. Narration being TDS deducted by so and so. Under section, which is section where they deducted the TDS mentioned on the narration, being TDS deducted by so and so under section 194J, 194A, 194H, whatever the section at the rate of so and so. Save it. Now we completed the two entries. Go to the third one for creating the income tax provision. Our entry will be income tax provision account debtor. Say it is 65,000 to provision for income tax. Our debit will be on income tax and the credit will be to the provision for income tax. So debit income tax 65,000. Give the credit to provision for income tax 65,000. Narration being income tax provision created for the financial year so and so. Now we created the provision. Now let's go to three ledgers. First one is advance tax. It is showing the debit balance of 50,000. It is an asset. TDS receivable. It is also showing a debit balance 10,000. Provision for income tax. It is showing a credit balance of rupees 65,000 because we have to pay to the government. Now we have to set off the income tax provision with the advance tax and the TDS receivable. Now again go to the voucher journal. First we have to transfer the advance income tax 50,000. So debit to provision for income tax 50,000 and the credit will be given to advance income tax 50,000. Narration being advance tax amount set off with the provision for income tax. Now completed. Now pass the second entry for set off or transfer the TDS receivable with the provision for income tax. Again debit to the provision for income tax. The amount will be 10,000. Credit will be given to TDS receivable 10,000. Narration being TDS receivable set off against a provision for income tax. Now go to the ledger of these both advance income tax. See, now the advance income tax is showing a debit of the payment and now it is transferred to the provision for income tax. Here the account is showing nil balance. That advance income tax set off against the provision for income tax. Go to the TDS receivable account. That is also showing a debit and credit entries. Now the closing balance showing 0. It is also set off against the provision for income tax. Now go to provision for income tax. What will be the amount? First we have passed the payable entry that is showing here as credit 65,000. Against 65,000 we adjusted the advance income tax and TDS. Now the account showing 5,000 as the tax liability to be payable to the government. So on the next stage we remitted this 5,000 to the government. So go to vouchers, payments, debit to provision for income tax 5,000. Credit will be given to the bank. Narration being remitted the income tax payable. Now go to the provision account, provision for income tax. That account is showing nil balance. Now we paid off everything. Now I think you may understood the entries up to this stage. For the next stages we have to see the refund, the excess amount. So I am removing these entries from here. Then only we can understand. We can go to another situations for refund. How it will happen? Suppose in this case the provision for income tax account showing a credit balance of 65,000 that is to be remitted to the government. The TDS account showing 10,000. Go to the TDS receivable account. It is showing the 10,000, and we are making the advance tax payment of 60,000. Suppose. So go to voucher. Make the payment of advance tax 65,000. Now we made the advance tax payment. Now our advance tax account is showing 65,000. TDS receivable showing 10,000. Total will be 75,000. But the provision for income tax is showing only 65,000. Now set off this advance tax and TDS against the provision. Go to voucher. Make the payment journal entry. Provision for advance tax 65,000. 2. Advance income tax 65,000. Narration being advance income tax transferred to provision. Save it. Now transfer the TDS amount receivable to the income tax provision. So debit provision for income tax 10,000 to TDS receivable 10,000. Narration being TDS receivable transfer or set off against the provision for income tax. Now our advance tax account is closed. TDS receivable account is closed. Now go to provision for income tax. Now the provision for income tax account is showing a debit balance of 10,000. That is the amount receivable because we paid the excess amount to the government. 10,000 excess. That we have to get it back from the government as the refund. So go to the next journal entry for recording the excess amount paid. Debit to income tax refund receivable 10,000. Credit will be given to provision for income tax 10,000. Narration being excess amount paid to the government transferred. Now go to the provision for income tax account. Now the account is showing nil balance. Account is closed. Now our liability is closed. Go to income tax refund receivable account. That account will show a debit balance of 10,000. This will be on the asset side of the balance sheet under current assets. So this much amount we have to get it back from the government. So on the next stage we are receiving this amount from the government. So what will be the entry? Again go to the voucher. First it is asking the credit side. So the income tax refund receivable 10,000. Debit will be given to concerned bank account, State Bank of India 10,000. Narration being income tax refund receivable received from the government. Save it. Now go to the income tax refunds receivable account. That account will be closed. That amount we received from the government and this account is closed. On the next case, we are receiving an assessment order from the income tax authority for making an additional payment of tax. So go to voucher. We have to make the payments. Go to payments. The debit will be income tax. Suppose it is 5,000. Credit will be the concerned bank account. Narration being income tax paid as per the assessment order of so and so financial year or assessment year. Now we recorded the remittance to the government, but we are not remitting the amount now. We filed appeal, but we have to account it. So go to voucher, passage entry, income tax account debit 5,000. The credit will be given to income tax payable 5,000 because now we recorded our liability. This much income tax is payable to the government as per the assessment order, but we are not remitting now. Still it is showing as a liability. It will be shown under current liabilities. So when we make the payment to the government, again we can pass the entry, payment entry, debit to income tax payable account 5,000 to concerned bank account 5,000. Now the income tax payable account is closed. On another situation, we are setting off the income tax receivable with the income tax payable account. So go to the journal, debit income tax payable, suppose 1,000. The credit will be given to income tax refunds receivable 1,000. Now the income tax refund receivable for the previous financial years set off against the income tax liability raised by the income tax department. Now save it. This is the way of setting off the income tax refund receivable with the income tax liability. This entry we can pass only if the income tax department permits to set off. Suppose if the income tax department is asking to make the payment, we have to make the payments. We can't set off. But in the assessment order, the income tax department itself has set off the amount. Then we can set off it with the bypassing these entries. On the next case, we are receiving the income tax refunds receivable from the government. Here we are receiving it. So credit to income tax refunds receivable. Here in this case 2,000. Credit will be given to concerned bank account. Narration being income tax refund receivable received. Now our income tax refund receivable account is closed. Suppose we are receiving this refund along with the interest. Then what will be the entry? In that case, we have to pass a common entry. The first will be the income tax refunds receivable. Suppose 2000 in that account. Again, we are receiving an interest. So credit will be given to interest on income tax refund 100. Then the debit will be given to the concerned bank account 2100. Narration being income tax refund receivable from the government rupees 2000 along with the interest of rupees 100. Now we completed almost 12 stages of income tax adjustment. If you really like the video, please like, share and drop your comments, and requesting to subscribe my channel and kindly enable the bell icon to get real-time notifications. So many practical and useful videos are available in my channel. Kindly go through it. We can study everything very well. We can meet on next video. Till then, bye.